Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner practitioner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. Appreciate your time and your attention. It's been a few weeks. It's been a couple weeks since we put out a fresh episode. Within the practice, we're going through another stage of growth and wanting to make sure we're taking care of the families we are privileged to serve and our clients. I took a step back from the podcast, but happy to be back behind the mic, and wanted to talk today about key tax planning levers that you can think through as you look at your practice profit through the rest of the year, as you are talking with your own professionals about tax planning through the rest of the year. I wanted to share some things I'm seeing as I'm going through that with my own clients. This is the time of year where we are going through those initial tax projections with clients. I've projected out the profit and loss, expected profit and loss throughout the rest of the year. I've gone through that with clients who I'm communicating, working closely with their tax professionals, ultimately to see where are the opportunities to either improve on or solidify our tax planning. As I've gone through those with our clients, I wanted to share some things that I'm seeing and some key opportunities, key tax planning levers that you can consider for your own tax planning. Because if you look at the flow of a tax return, for example, and for us, when we look at those projections, there are certain key areas of that tax return that when we aim for those key areas, when we pull certain specific levers, can have a really high impact on ultimately the result. And so this episode is going to take a higher level overview at those key planning areas. And we often just want to talk about the strategies, right? What are the fun, exciting strategies? What are the tactics? What magic ways can we get those deductions? That's usually what we want to talk about. But I think it's useful to take a step back and say, okay, what are we really planning around? It may not make sense to just pile on deductions in one tax year, or pile on tax deferral into one tax year, or depreciation in one tax year. We really want to take a look at our tax plan and say, well, what are we targeting? And what are we actually planning around? And once we have an idea of that, you can then turn to, okay, what are our tactics? What are our certain deductions we're going to use and things like that in order to get those results? And so those are the things I want to talk about today. And before I do that, I wanted to say, if you are planning to head to Vision Expo this week, I will be there on Thursday and Friday. We'd love to connect with you, talk to you about what's going on in your life and in your practice. And if you'd like to connect in person, you can always reach me here at Evon, EVON, at optometrywealth.com. Would be great to see you there. But let's dive into tax planning. And one of the first things we want to project out and get a pretty good grasp on is our income trajectory for the year. And what are the different types of income that we're planning around? There's probably going to be business profit if you own a practice. If your practice is taxed as an S corporation, there's going to be a wage for you, potentially your spouse as well. Do you own real estate? Is there going to be rental income or losses? Is it commercial real estate connected to the practice, or a short-term rental, or is it a long-term passive rental? Are there taxable brokerage accounts, and what kind of income and dividends and interest are those brokerage accounts going to be kicking off? And have you sold large assets? Are they going to be capital gains, either from those investment accounts, from selling a rental property, from selling a home higher than the exclusion amount? And so we want to get a good feel for what type and what amount of income we are reasonably projecting out throughout the rest of the year. And obviously, with an optometry practice, how the rest of the year unfolds isn't set in stone. That's something we have to project out and use reasonable assumptions, including things like seasonality. So these projections are always sort of living, breathing projections, right? We want to update them as the year goes on, but want to at least get a reasonable feel for what our income is going to look like this year. And a really important note here, one thing that's really important is clean, accurate bookkeeping in your practice. And if you don't have clean, accurate bookkeeping, if you don't have any bookkeeping software and you're just sending your accountants all the receipts and everything at the end of the year for tax purposes, it's really difficult to do any type of proactive planning around taxes, or I would add even cash flow in the business. You really want to have clean, accurate bookkeeping in the practice, and that's updated on a regular basis so you can make accurate projections and make good decisions based on that data. And so Now that we've gone through that exercise of putting all the income building blocks together, we have a good feel for what that income and expenses are going to look like through the rest of the year. Now we can talk about our first sort of planning lever or planning opportunity, and that is your tax withholdings and estimated payments. And this could look a couple of ways. So for example, if you are the owner of an S corporation, you're going to see a wage, and that wage is going to be withholding federal tax payments and potentially state tax withholdings as well, depending on the state that you're in. And in addition to those payroll withholdings, you may also be paying quarterly estimated tax payments. At this point, you've already likely made the first 3 payments. September 15th was the most recent one. And now we're talking about January 15th as the next one. And so once we've projected out sort of the tax projection for the year, we want to get a look at where are our tax payments, what's the trajectory of tax withholdings, and are we on track? We want to know that your withholdings and estimated payments are on the same trajectory, on the same track with our total tax we're projecting. Or are we expecting a substantial tax due at tax time? Or are we expecting a substantial refund due at tax time? This isn't the most exciting or glamorous form of planning, but one of the biggest frustration for many clients I talk with are surprises at tax time. And one of the easiest ways to bring down the stress of tax time is to at least get your withholdings and estimated tax payments on track for what we expect that total tax to be. And ultimately, our goal is just no surprises. And so there's a couple targets you might aim for withholdings. The first target are the safe harbor rules, meaning the IRS says if you withhold or pay in a certain amount throughout the year, they won't apply under withholding penalties. And there's 2 versions of the safe harbor rules. Number 1 is if you withhold at least 90% of this year's total tax, you won't have to pay an under withholding penalty. The second version is if you withhold at least 110% of last year's total tax, you won't be subject to that penalty. So it's either going to be based on this year's total tax or last year's total tax. And for the most part, if you expect your taxable income to be roughly the same or higher than it was last year, you're probably going to want to use that 110% of last year's total tax. In fact, a lot of the estimated tax payments that are suggested on those tax returns each year are going to be based on that safe harbor amount. But if you know your income is going to be much lower this year, if you know for example, your practice profit is going to be much lower this year. One client, for example, of ours, they lost an associate doctor. So total doctor hours came down. They were going to see lower revenue and profit for this year. So that's one example. If you know your taxable income is going to be lower this year than it was last year, maybe you're going to use that 90% of current tax. So one target's going to be one of those safe harbor rules just to avoid that under withholding tax. And of course, that second target's going to be as close as possible to the anticipated tax due at tax time, or at least saving up enough dollars to get you to that point at tax time. So number 1, reviewing your tax withholdings, you're reviewing your tax payments, making sure we are on the right tracks so that there's no surprises in April and it's not as painful as it might be. The next thing we want to look at is your adjusted gross income, which that's a tax jargon term. What that means essentially, if you look at your tax return, it's all of your sources of income minus a bunch of deductions. And this adjusted gross income AGI is a really important planning line item because it impacts your eligibility for certain deductions and credits, as well as additional taxes. So for example, the child tax credit, which is a dollar for dollar offset of the taxes that are due. The child tax credit is $2,200 this year for each qualifying child under age 17. That child tax credit begins phasing out at $200,000 of AGI if you are single, or $400,000 if you are married filing jointly. And so once you start to get to those ranges of AGI, that child tax credit begins to phase downward. And so that's an important opportunity we want to plan around. If your adjusted gross income, if you are married filing jointly, is $250,000 or higher, and you have any investment income like capital gains, dividends, interest, things like that, that investment income starts to become subject to the 3.8% net investment income tax. It's also really important for student loan planning because AGI is the default way that income-driven repayment plans calculate their payments for the next 12 months. And if you are using income-driven plans towards forgiveness, that IDR payment is essentially a 10 or 15% tax on much of your income. That adjusted gross income is really important for student loan planning as well. So we want to keep a really close eye on this. And what we might want to target, for example, we might want to look at AGI and say, okay, are we phasing out of the child tax credit, for example? What is our adjusted gross income expected to be? And what are we phasing out of? Because that becomes a target we can plan around. We can try to bring down that AG9 number in order to phase into, again, for example, that child tax credit. And when planning around this, it's important to look at which deductions or tax deferrals directly impact the adjusted gross income number. Many deductions do help to lower that, but there are other deductions that are below that on the tax return. And so we want to prioritize for this things that are 401k contributions, for example, or simple IRA contributions, HSA contributions, health insurance, self-employed health insurance premium deductions, for example, business deductions or depreciation on real estate, for example. Those are all examples of deductions and tax deferrals that directly lower adjusted gross income. And so those are the things we might want to prioritize when trying to plan around that. An example of something that is a deduction but doesn't lower that adjusted gross income number on the tax return is the standard deduction or itemized deductions, which leads us to the next planning lever, number 3, itemized deductions. And every taxpayer, if you look at your tax return, if you look at the way taxes work, every taxpayer can choose between a standard deduction amount, or you can stack up a list of itemized personal expenses. And if that list is higher than the standard deduction amount, then you can take that list of itemized deductions. For 2025, the standard deduction amount is $15,750 if you are single or married filing separately, or $31,500 if you're married filing jointly. And so that's sort of our target there with itemized deductions. And what's on that list? Well, it's mortgage interest expense. It's mortgage interest expense. It's charitable contributions, donations to nonprofits, charities, churches, state and local taxes, certain healthcare expenses. And so those are the expenses we're looking at. And there's a couple really important One Big Beautiful Bill Act updates that we want to take into account for this year when planning around itemized deductions. Number one is the increase in the cap for the state and local tax deduction. From 2018 to now, the amount of state and local taxes that you can take as an itemized deduction was capped at $10,000, which severely capped you if you lived in a high state tax state like California, potentially New York, New Jersey. And as a result of the One Big Beautiful Bill Act that was recently passed this year, that state and local tax cap, deduction cap, has increased from $10,000 up to $40,000. However, that increased cap begins to phase down for higher earners once what's effectively your adjusted gross income gets to $500,000. And so that $500,000 to $600,000 of income, that range becomes a really important planning range based on how that higher deduction phases down. It never gets below $10,000. But that $100,000 of income, if you're married filing jointly, can be very expensive because of the way that phases down. So that increased state and local tax cap is something we're keeping an eye on for those higher earning, mostly practice owners within that income range. The second thing we're looking at are charitable deductions, because the rules for charitable deductions didn't change for this year, but did change for next year. One of the things that changed is that there is a charitable deduction available, whether you itemize your taxes or not. It's small, it's limited, but there is going to be something available next year, even if you don't itemize your taxes. So we're going to have to start keeping receipts again, for those charitable contributions. But the other thing that changed is that starting in 2026, there's an AGI floor that your donations to charity has to get through in order for them to be deductible. So starting in 2026, there is a 0.5% AGI floor, meaning that your deductions have to be more than 0.5% of your adjusted gross income. And once they get beyond 0.5%, then they actually start to get deductible. For example, if your AGI is 300,000, 0.5% of that would be 1,500. And so the first 1,500 of your donations aren't actually going to be deductible. It's everything above that. So this is the last year to make those donations without being subject to the AGI floor. And if your AGI is relatively high, well, that's a higher floor that you have to get to in the next year and beyond. In general, due to the higher standard deduction amount, what we've seen work very often are bunching charitable donations into like every other year or every third year, for example, in order to get those itemized deductions higher than that standard deduction amount. That's something that probably still makes sense moving forward since the standard deduction has been made quote unquote permanently higher. And so whether that's donating directly to the nonprofit or charity or church, or donating to a donor advised fund, I think that those bunching of charitable contributions continues to be something we want to keep an eye on moving forward. And so those itemized deductions are something we want to take a look at and plan around. Are you going to be hitting those phase outs for the state and local tax deduction cap? What are your charitable contributions? Or are they going to be high enough? Should we accelerate maybe next year or the next 2 years into this year and bunch them together in order to make them useful from a tax planning perspective? The next level we're looking at is the qualified business income tax deduction. And this is a 20% deduction for you business owners and practice owners that own a pass-through business. So if your business is a sole proprietorship or taxed as a sole proprietorship, if it's taxed as a partnership or an S corporation, that's you're eligible for this. And this is a 20% deduction of what's effectively net operating income of the business. And for optometry generally is what the IRS calls a specified service business, which means that once your taxable income before the deduction reaches certain thresholds, you start to phase out of the QBI deduction, meaning you start to little by little be eligible for less and less of it. And then once your taxable income before that deduction gets to a certain higher threshold, then you phase out of it altogether, which can be substantial depending on the profit of the practice. So in 2025, the thresholds, if you're single, are $197,300, and you have $50,000 of income until you hit the top threshold. So that top part's $247,300. And if you're married filing jointly, that threshold starts at taxable income of $394,600. And you have $100,000 to go until you hit that top threshold of $494,600. And so those are the ranges we're planning around when we look at this QBI deduction. This is a really important lever we want to look at. Are we phasing out of it? And are there opportunities to bring down that taxable income in order to phase you back into it more and more? And then lastly, we're looking at taxable income. And this is obviously important because of that qualified business income deduction we talked about. But also it's important because taxable income determines the actual tax rates your income is going to be taxed at. Taxable income is what goes through those tax brackets to figure out what is your tax due. And so that tells us, okay, what is your marginal tax rate, meaning the tax rate that your last or highest dollars of income are going to be taxed at. Is it going to be 10%, 12%, 22, 24, 32, 35, and so on and so forth? And it's the same thing for capital gains type income. So if you have long-term capital gains, meaning you've sold an investment asset that you've owned for longer than a year, or if you have a type of dividend called qualified dividends, those are going to be taxed at 0%, 15%, and 20%. And whatever that tax rate is, it's going to be determined by your taxable income. And so if we can look at opportunities to bring down that taxable income to potentially bring you into a lower tax bracket, for example, maybe out of the 32 and into the 24, or if we can help keep you out of the next tax bracket, for example, avoiding that 8% jump from 24% to 32%. We want to look at opportunities to do that and manage those tax brackets appropriately. Same thing for capital gains. Hey, if we can get you out of the 15% and into the 0%, like that's phenomenal, right? We want to look for opportunities to do that. And so those are sort of the biggest opportunities for planning that I'm seeing as I'm going through these tax projections with clients, having these conversations with clients and their tax professionals. It's going to be first getting a feel for the income trajectory and what are the different types and amounts of income we're going to be working with. And then looking at withholdings and estimated payments. Are we on track? Do we need to make adjustments while we still have time to do so? looking at adjusted gross income, looking at, are we phasing out of anything? And what can we do to bring down that adjusted gross income number to phase us back into those things? Looking at itemized deductions. Is there planning opportunities with itemized deductions to bring them above and beyond the standard deduction amount? And then looking at things like that state and local tax cap and charitable contributions. Then looking at the QBI deduction. Are we phasing out of that, and can we phase you back into that? And then lastly, looking at your taxable income and managing our tax brackets. Are there opportunities to bring you into more favorable tax brackets, or are there opportunities to keep you out of an additional tax bracket? And the fascinating thing is when you start to look at these things together, your potential deductions or tax deferrals can have potentially a much higher impact than just the marginal tax bracket that you're in. And what I mean by that is that very often we'll see that, okay, if you are in the 32% tax bracket, if you get a $10,000 deduction, you're thinking, okay, you're saving 32% of $10,000, which is going to be $3,200, right? That's kind of what we're thinking. You're saving 32% on that deduction. However, when we combine these different tax planning levers together, we can see that a deduction can lead to a much higher effective tax savings, like an effective tax rate, than just that marginal tax rate that you're in. If you're able to, for example, if you're able to bring down your adjusted gross income and bring down that taxable income, you may be able to do several things at once. You may be able to phase into a higher child tax credit, which will offset dollar for dollar the tax that's due. You may be able to increase your QBI deduction, which lowers your taxable income. You may be able to increase those itemized deductions, which lowers that taxable income. So if you pull several of these levers at once, a $10,000 deduction, for example, may have a $20,000 decrease in taxable income and a very healthy, effective tax rate you're saving at. Now, I'm just throwing out examples, right? That's not based on any specific example I've been looking at, but that's sort of the concept. When you can pull several of these levers together, you can have a much larger impact than just that marginal tax bracket you're looking at. And so those are some opportunities you can start to think about as you are having these conversations with your financial professionals, as you're having these conversations with your tax professionals. You can look at these different opportunities, these different levers, and ask yourself, hey, what are the types of income I'm working with? Are we phasing out of anything that we can try to phase back into? Are we phasing into any additional taxes that we can try to phase out of? Where are these opportunities and levers to pull? And how do you do that? Well, that's where those conversations become really important, because you can say, what are the opportunities that are specific to you, right? You want to get a projection done by your professionals and look at the opportunities that are specific to you. It's going to be, generally speaking, some combination of planning in the business, looking at opportunities to reinvest in the business, potentially, for example, especially as we're getting to Vision Expo, buying equipment that has a true business use and a return on investment, or whatever it may be, reinvesting back into the practice and using those expenses as tax deductions, or using depreciation. Or it could be other things, like if your kids can legitimately do work in the practice, maybe you can add your children to payroll and use that as an opportunity for tax planning as well. So it's going to be some opportunity of planning in the business or evaluating the business entity, depreciation planning around real estate, especially if you're buying the commercial real estate of your practice, or if you own a short-term rental and you follow the short-term rental rules, because tax losses from that type of real estate may be used to offset all of your other active type income, like practice profit. And especially now that the One Big Beautiful Bill Act reintroduced 100% bonus depreciation, and that can potentially be combined with a cost segregation study in that real estate. That's another potential opportunity to use there. It could be using retirement accounts, so using your 401k in the practice, for example. And that's not only the employee contributions, but also profit sharing contributions. If the cash flow and the demographics of the practice make sense, for very mature, very heavily cash flowing practices, maybe a cash balance plan, if that makes sense. So looking at your retirement plan and asking, can we get the most out of this retirement plan? maybe it's time to switch from a simple IRA over to that 401k plan now that we can do that mid-year. Or it could be using charitable contributions, as we talked about, using, for example, donor advised funds to bunch those contributions in the current year, benefit from that tax planning, and then actually make those donations over the coming years out of that donor advised fund. Those are some general sort of categories you might think around, but ultimately it comes down to, what do your own professionals advise? It's going through that projection with your own professionals, having those conversations with your own financial and tax professionals. And if you aren't, reach out. We'll love to start these conversations. We're getting into the end of the year, right? We're getting into the fourth quarter pretty soon. It's time to start thinking about tax planning for the year and seeing what opportunities are ahead of us. And in addition, one thing I'll link to in the show notes is an article I did for Independent Strong, all about these key tax planning levers for practice owners. And so that'll be something you can find in the show notes. Let me know if you have any questions. You can reach me here at Evon, EVON, at optometrywealth.com. If you want to talk about what we've talked about today on the podcast, or if you just want to chat in person at Vision Expo, always happy to have a conversation and appreciate your time. We will catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.